Hey everybody, Peter Lassar here, author of Restaurant Strong, and we're going to cover restaurant planning in 2023. And I want to give you a little bit of context before we get into the year ahead by looking back at the last couple of years, as there are trends that are going to be unwinding, as you'll see, and new trends that are going to be winding up. And the way we think about our business in the year ahead should really be as a result of what is disappearing and what is coming. Okay. So I'm a macro guy. For those of you who don't know me, I've been the CFO of a publicly traded hospitality company that we took from ground zero to a peak of about 5,000 employees, and from basically no revenue to a peak of almost $200 million of revenue. I've been the president of a hospitality company in Asia that we took from ground zero to about $50 million of revenue. And in my work with the industry, I do a lot of work in the macro space. Okay, and so I really want you to benefit from some of the things that I'm seeing, so you can put my opinions and the data you're going to see into your own toolbox and figure out your own way forward. Okay, so this is not a generic presentation. The idea is that uh, uh, it's going to give you some tools to think about your individual market, your individual circumstances, and not just sort of a blanket global picture. Okay, so let's jump in, and we're going to start first with macro trends, and then we're going to get into some key conclusions. So the U.S. Federal Reserve, for those of you who might not follow this that closely, sets monetary policy for the United States, right? And their mandate is to protect full employment and keep inflation at 2%. That's their dual mandate, correct? And of course, we all know they have been faced with this situation in which inflation has been vastly superior to 2%, and employment has basically been at full employment for some time, right? Therefore, they are turning to solving the inflation problem while trying not to do undue damage to the rate of employment. Okay, and they meet on a regular basis, and they change and update their policy, and or their policies, I should say, and those policies are also communicated to us in a way that they allow us to understand what they see coming down the pike. Okay, so I want to let you know, as of this December 2022, what their latest policies are, really big picture, and what they see coming down the pike. Okay, so first of all, the Federal Reserve raised the Fed funds rate by 50 basis points to a range of 4.25 to 4.5%. Now, what does this mean? This means that when banks start to make loans to consumers or to businesses, right, they are in effect having to lend at higher and higher rates. So, as an example, previous to all these rate hikes, so really about a year to a year and a half ago, people could get SBA loans at sub 5%, right? In terms of an interest rate. The latest SBA loans are now at 9% plus if you're getting them. So the Fed funds rate has this knock on effect where even the most subsidized interest rates in the United States are skyrocketing. And that means that your ability to borrow obviously decreases, but everybody's ability to borrow decreases. And as a result, there is less stimulus in the economy that stimulates an increase in employment, because they don't have a good part of their ability to, businesses don't have a good part of their ability to invest. And the lack of ability to stimulate growth means an impact over time on employment and on consumption, right? Which has a direct effect on restaurants. So that's key to understand. Moreover, policy makers, individual forecasts, so the collective policymakers affiliated with the US Federal Reserve, forecast a Fed fund rate above 5% by the end of next year. So 5 to 5.25. So we should expect the interest rates that people are having to pay in different types of borrowing transactions, from credit cards to SB loans to car loans to home loans, etc., to continue to bump up, right, over this coming year, because the Fed is trying to continue to create a series of financial series of sort of conditions that are subsets to the whole financial conditions of the economy that depress demand, to bring demand and supply back into balance so that inflation starts to fall towards that 2%. Okay. And as a result, policymakers believe that the US economy should grow by about 0.5% in 2023 as unemployment rises to about 4.6% from today's 3.7%. Does that make sense? In other words, by having an impact on demand through increasing the interest rates, slowly but surely, businesses are going to have to reduce hiring, and also, in many cases, even reduce the current payrolls that they have, and that should push unemployment up. Now, you might think this is good news, and it is to some extent for the restaurant industry, because we are suffering from a lack of employees, and therefore it should continue to get easier, as it has to some extent over the last 6 months. But that trend should continue, and perhaps even strengthen, to find employees, but just at a time when you might not want to hire anymore. And that's going to be sort of part of your own decision matrix, right? How am I hiring people? How am I changing the wages that I'm offering? How am I changing the benefits that I'm offering, given these loosening financial conditions, or tightening financial conditions, I should say, that are creating more unemployment, but also starting to suppress demand. Okay. So I want to bring this idea now of inflation to you on an individual level within the United States. This is September 2022 data. It's 3 months old, but there's an underlying message here that applies today. If you look at the upper left-hand corner, it shows inflation rates, core inflation rates, from 7.6% to 9.2%. Okay. And their color codes affiliated with different states. Okay. So go ahead and find your state if you're in the United States for a moment, and match it to what the inflation rate looked like in September. So what's the point? The point is that inflation increases or falls at faster and slower rates depending on where you are. There's not just one big macro average, but it's built up of inputs from different states around the country. And so if you are, in the middle of the country, just west of the Midwest, right, you experience a relatively low impact from inflation as compared to the mountain states. They experienced a very high impact from inflation. And so as we turn the corner, and as inflation rates start to fall, you should continue to experience disparity based on where you are. Okay. And that means that restaurants that are in mountain states are going to continue to see a greater impact from 2023 inflation as compared to those that are in their neighboring states to the east. Does that make sense? And that can help you to sort of speculate a little bit what is going to happen to you. Now, to clarify, just because the inflation rate is decreasing does not mean that prices are not going up. Prices are going to continue to go up, and we're going to get into what price increases look like for inputs in the restaurant industry in a couple of moments specifically, and then you can sort of look at your individual state to see how you might be impacted by reflecting back on this image. But the reality is, if prices at the end of 2022 were 100, then, and the inflation rate for the whole country was going to be 5 to 6% in 2023, then your input prices are going to be 105 to 106, not 100 by the time we get through the end of the year. Okay. Just because we have a falling rate does not mean that the price increases are not rising. They are. It's just the rate of increase is lessening. Okay. And therefore you're going to continue to feel the pinch from higher labor rates to some extent during this year, higher food costs to some extent this year, higher rents to some extent this year, depending on where you are, and so forth and so on. Okay. So I want to break this down into individual states. Not all states are here, but it's going to help you to understand another factor that is driving demand to help compensate for the increase in input prices. Okay, we have a phenomena which we're all familiar with, which is that people are moving out of some states and they're moving into other states, and this plays down to the state level, but also even down to the city level, right? So if you look at California in the upper left, and you move all the way to the right, it says 2020, 2021. There are far more people. The ratio is 59.4% moving away from California than the 40.6% moving toward California, right? California is experiencing a net decrease in population, right? And so it is really hard to increase your revenues when people are moving away from you, right? And therefore, if you are in a state that is losing population or a city that is losing population, you are fighting an uphill battle to increase revenue above and beyond your increase in expenses. Okay, so you need to look at your own individual state. Texas, on the other hand, 54.5% moving to, 45.5% moving from. Virginia is, or Florida is very net positive. Virginia is slightly net negative. Illinois is very net negative, for example, as you look at the bottom numbers. So you might look at your state and really understand how dramatic the improvement or the decrease in net population are, and even drive down to your city level to really determine how much demand is going to be generated organically by new people coming in or people leaving. Okay. Excuse me. So there's a phenomena which underlies what I just said, and that is people are moving out of high cost, large metro areas to other types of regions. They're moving out of high cost, large metro areas to other types of regions. And this is very, very painful for some, and is providing a lot of advantages to others. So I'm going to increase the size of this chart here so that we can actually see a little bit better the data. Okay. If you look at the blue line, the dark blue line in this chart, this starts in 2009 and goes basically into the end of 2021. You will see that since 2009, since the financial crisis that started sort of 2008 to 2010, we have seen an influx of about 15,000 to 16,000 people a month by 2021 of folks into lower cost large metro areas, right? So this is a phenomenon in which people will be moving out of Chicago, right? But they would be moving to other cities, i.e., like Detroit, for example, that were large but lower cost. Okay. And that rate has been increasing almost month after month after month. Okay. And is now, as of the end of 2021, about 16,000 to 17,000 people a month. Okay. If you look at the gray line, these are mid-sized metro areas, right? And so this might be a second tier city, right? Not a first tier city. the same phenomena. People moving out of New York, moving out of LA, moving out of San Francisco, moving out of Chicago, right? To second tier cities that could be in their own states, right? But are also likely to be in adjacent states or in southern states. Okay. So Indiana has experienced a net gain in population because people from Chicago, to continue to use Chicago as an example, have been moving into second tier urban areas in Indiana, right? As they move out of the Chicago area, right? And in your state, this is probably also likely playing out. So if you are in a second tier city, you can likely continue to rely on people moving into that city. And if you're in a first tier, high cost metro area, you can unfortunately rely on the probability that your net population will continue to decrease. Okay. Lastly, if you look at the red line, people are really moving into small metros, small towns, and rural areas as they can no longer afford to be in urban areas at all, and as minimum wages apply statewide, right? So minimum restaurant wages don't only apply in, Tampa or Miami, right, in Florida, but would apply in other parts of the states. The same would apply for New York. The same would apply for California and many other states that have minimum wages. And so people that are earning minimum wage can count on earning similar amounts of money by going to really low cost areas. And now we're at 23,000 people a month moving to areas like that. And they are continuing to see upswings even as larger, higher cost areas are continuing to suffer. Okay. So let's now look at, at middle class wealth. This is important for you to understand regardless of where you are. Okay. But I want you to also think about it sort of both on a global picture, but specifically where you are. Now, global middle class wealth, which is a methodology that looks at income levels, that looks at the value of middle class assets, that looks at the liabilities of the middle class, and comes up with a measurement. Peaked around February, March 2022, early this year, and has been on a sharp decline. Okay. And if you go back to 2017, you'll see that we had a pandemic decline, right? We had a decline in 2018, right? But look at the level of decline really in the last 10 months, and you will see that it looks to be sharper and longer than the previous ones, okay? And in 2023, this is projected to continue to increase. This is not a bottom that we are seeing, but rather as unemployment goes up, as savings go down, as we'll see in a moment, as credit card spending balances go up, as credit card delinquencies go up, middle class wealth is going to decline. Now, in some states and in some areas in some states, this effect will not be so great because you might have really strong employers who've moved into the state recently, right? You might have really great net gains in population, correct? But you will still feel an impact, okay? You just might feel it suppressed. In other areas where there's a net migration out, right? Or there are fewer jobs, right? So Austin, Texas has seen a huge surge in not just population, but in job growth as employers have moved to the area, right? And New York City and LA and Seattle and some other cities are seeing some declines, right? So middle class wealth will probably fall sharply in those sorts of areas and not so sharply in other areas. And you need to think about this if your clientele are mostly middle class or are at least in part middle class, how that is going to impact you. And one trend we're seeing very clearly is that, and for example, Applebee's has announced that their growth market right now are people who are earning $100,000 or more, right? As people who are earning less are moving away from them and into lower cost formats, they are starting to get people from higher cost formats coming to them, right? And so as you're thinking about this, you really should think about your own format and the market that you have not been getting that usually pays a higher price point that you can start marketing and positioning toward as your growth market, as perhaps the lower end of your market is moving down to a cheaper way of consuming food or consuming food from restaurants and the like. Okay, so personal savings rate is falling dramatically. And this is just to emphasize the amount of money that is available for spending in restaurants. Okay. If you look back to 1960, the personal savings rate held pretty steadily on a growth pattern through 1975. It then fell dramatically all the way till about 2005. You can just see how it's just falling, 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 falling. Okay. And about 2006 or so, it starts to turn and has been increasing ever since. And then with the pandemic, people panicked. And when people panic, they start saving money, they stop spending money. And obviously, the whole service economy was really shot, during that period. And savings rate blasted up to over 30%, something we haven't seen in many, many decades. And now, as the pandemic ended and people were able to go out and spend, they started to spend their money. And now the economy is starting to turn, and all of a sudden, people are caught with less money, and slowly, what is happening is wage growth is decreasing. Slowly, there's softening in the employment picture, and the personal savings rate is dropped back to almost 2005 levels, okay, which is the worst that they have been since 1960, okay? So what happens is when people don't have savings because they're using their savings to fund their daily expenses, slowly they are changing their lifestyle to accommodate for having less money in the bank, okay? And it takes a while for people to get there, but slowly they start to get there, and their spending habits on everything, including on restaurants, starts to change, right? And there have been surveys in this past year that have said, as I have less income or less wealth or less savings, where do I cut? And spending on restaurants is often right towards the top. Okay. So we can expect this to impact you differently, again, based on your geography. So I go back to everything you've just seen, but it will still have an impact on your revenue in the year ahead. Okay. So as savings decrease, delinquencies on credit cards and credit card balances in general start to increase. And that really starts to tighten people's financial flexibility. So, in with the pandemic, people were saving more money. They were paying down credit cards. We really hit this great decline in delinquency rates on credit cards to a historic low in a long, long, long time. But delinquencies are now again on the rise, and in 2023 we should expect that rise. As we look at this a year from now, to move up quite a bit higher than where it is today. Okay, and that means that as it moves higher, we should expect restaurant revenue to move steadily lower in terms of its growth rate. Okay, and maybe even move into some markets into a negative situation. Okay, so let's talk about restaurants a little more specifically. This is from the International Food Service Manufacturers Association, and it's their forecast for what is going to happen in 2023. So here they say that the spend in the food service industry will decline by 0.1%, considered flat on a real basis in 2023 compared to 2022. Okay. So the actual spend will fall. Okay. Just slightly. What that means is in some areas it will go up, and in some areas it will go up sharply, and in some areas it will fall sharply. There is an average that they are projecting. Now let's move down to the next red line where it says, while the projection is for flat growth in 2023, in real terms, IFMA projects that the industry will see inflation of 7.7%. Okay, this means most food service segments will spend more in 2023 than they did in 2022 as a result of higher costs of goods rather than increased consumer demand. So, input costs for you will continue to rise. The IFMA, which is comprised of food service manufacturers, is on top of data, right? And they forecast that the input costs for our industry will go up by about 7.7%, even as revenue is flat to down, sharply down for some and up for others. Okay. Now, how should you think about this, right? Well, if you are in a state in which input costs have been increasing, right, as you saw in that map, okay, and they've been increasing at a higher rate than others, excuse me, i.e., like the mountain states. But if you are in a state or a city that is seeing a decline in population and maybe a decline in employers, right, then you should expect to be really hit hard. Okay, you should expect a drop in revenue and an above average increase in input costs for you. Okay. On the other extreme, if you are in a state in which inflation has been relatively low compared to everybody else, but there is some net positives in terms of your migration and job growth, then you should actually not feel a huge negative impact. You might sort of be flat in terms of your ability to hold earnings for the year. Okay. And there are certain states that fit those parameters, and there are certain types of second tier cities and smaller areas that fit those parameters. Okay. And so you need to use all of this data to sort of estimate what is going to happen to you specifically, and then you need to prepare yourself accordingly. Okay. So I want to give you 7 planning conclusions to think about based on this picture. Okay. So the 7 key parameters to plan for are: first, consumer spending in restaurants. In my opinion, having looked at this analysis and having looked at a lot of other analysis, having spent time following other analysts that I respect on both sides of different sort of opinion ranges, I think that you should expect the consumer spending in restaurants to be -5% to +5%, depending on your location, and not taking into account net migration flows. Okay. Net migration flows might impact this even larger. So then it might be -7% to +7%. That makes sense? So this is the range I would give to yourself before looking at net migration inflows or outflows. And then I would add a little bit of buffer to it when you're looking at your forecasting for the year ahead and your budgeting and your resource allocation for the year ahead. Okay. 2, inflation will raise your expenses by up to 7%. Okay. Inflation will raise your expenses by up to 7%. When the IFMA did their forecast, which is a couple months ago, the impact of the Fed monetary tightening has started to see some positive impacts. I don't believe that the 7.7% forecast by the IFMA is accurate anymore for 2023. I believe it's falling. And so I think a maximum rate might be 7%, but I would think a minimum rate would be 5%, okay, in terms of your inputs. And so if I were you, I would be planning for a 7% sort of uptick in your expenses to prepare for a worst case scenario and see what that does, okay? Hiring will continue to get better throughout the year, not just the availability of workers, but if you have been paying well above minimum wage with lots of incentives, you might be able to taper that down a little bit for new employees to help protect your own cash flows as restaurant investors and shareholders and management to sort of protect the overall business to be able to continue to pay employees and provide great service and returns to investors in the years ahead. Okay, so that is the one sort of highlight from an owner, investor, shareholder management point of view. Okay, and four is I think that you really need to spend time understanding your market, and I really need to move through these. Excuse me. More deeply in terms of localized inflation and home ownership. I'm going to get that in a moment. Net migration and relative job growth. So, home ownership helps to flatten the impacts of consumer spending for restaurants, right? And I've spoken about this before, but I'm going to continue to reinforce it. If you are in an area in which there's strong home ownership, that can stabilize a little bit consumer spending for restaurants because people have assets and they feel comfortable by having those assets, even if housing prices are decreasing a little bit, versus if you are in a rental community, rents are going up, wages are flattening, unemployment is going up, and that can increase the negative effects on consumer spending in restaurants. Okay, so I would be making sure you understand not just everything we've gone through, but what is happening in home ownership in your area, as well as net migration, relative job growth, etc. You can spend an hour on this today to come up with some of your own estimates and see how they might impact on your forecasts. Okay. Number five, money won't start to get cheaper until 2024 and won't get cheap until at least 2025, 2026. So as the Fed fund rate ramps up to 5 or 5.25%, it is likely that the Fed will hold their rates high for all of 2023 to make sure that inflation is really falling towards that 2%. Okay. There are some analysts that believe that we could see a decrease in the Fed fund rate later this year, but the Fed is saying they don't think that's going to happen. Okay. Which means that we should expect borrowing rates of all types, credit cards, home loans, car loans, etc., to stay high through 2023 or be even slightly higher than they are as of the date of this recording, December 2022, and for them to really only start to get cheaper than they are today in 2024, but not to get cheap until at least 2025. So we might not return to rates that we have seen, in 2018, 2019, 2020, until even 2026 or beyond. Okay. So you don't really want to be borrowing today if you can avoid it, unless what you're borrowing for is going to get you a return on investment that greatly exceeds your cost of capital. Okay. You should be studying all new technologies that create efficiencies. All new technologies that create efficiencies. Why? Because technological development in our space is moving quickly. Restaurateurs tend to be very slow adapters. Those that adapt to changes and adopt new technologies that work for them more quickly are going to be able to rely on less labor over time as labor continues to rise in the future. And that will have a great impact potentially for you as you're coming out of sort of this period of time. So I would make myself an expert in all new technologies that are coming. Okay. I would focus on building your top line. Most restaurants are trapped by the cycles. Leaders are also, their revenues can swing based on the cycles, but if they are proactive in developing a growth practice, they can continue to outperform the marketplace and outperform the marketplace, not just in top line, but in income growth. And by the time things turn, they can now take advantage of an upswing that others who are weakened by a downfall period cannot. Okay, so if you're not developing a growth practice, if you're not really thinking about same store growth, then you need to turn towards that. Okay, spread your management expense while acquisitions are cheap. So if you're sitting on capital, I'd be making purchases in this cheap market so that you can start to spread your management expenses among additional operations, or build your balance sheet to take advantage of acquisitions as it makes sense. And then lastly, I would find the seams. I would find those areas in which you have the ability to grow in areas of the marketplace where there are gaps that might not mean an acquisition, it might not mean a new property, but could mean a ghost kitchen, could mean renting a kitchen space from a restaurant that's underperforming so that you can increase your delivery in other areas and so forth, so that you are continuing to build your top line and prepare yourself for income growth as we come out of this. This is a big, big dip that we're going through, and the smart business folks get prepared for that dip and take advantage of that dip, and those that are not thinking ahead get trapped in the dip and have trouble coming out the other side. Okay, so that is restaurant planning for 2023. I want you to take advantage of this. I'm just going to stop the sharing for a moment and to really make sure you're taking advantage of these changing conditions for the better, and not having these changing conditions take advantage of you, if that makes sense. Now, if you want to learn more about me, you can go to peterlassar.com. There is a training coming up, which is also already under pre-registration, which is on same-store growth and on growth practice that I subsidize for the industry. I finance over a period of months, in which you'll get to speak to me directly to help with your planning. So please feel free to take advantage of that while it's cheap. Again, that's at the top of peterlassar.com. And I look forward to continuing to serve you all in an interesting year ahead, and one in which I hope it will be exciting and positive for you.